Hello, this is Greg Giardino,
And I'm Allison Hall.
and this is It's Your Smarter Money. And today we'll be talking about the One Big Beautiful Bill Act, which was just passed here in July. We're getting a ton of questions from our clients. How does this affect me moving forward? Are there any tax saving opportunities? So we're going to talk a little bit more about some of the key provisions here that you need to know and hopefully help with you from a tax planning perspective. All right, so to save everyone a giant headache and to save time, I'm going to refer to the Tax Cuts and Jobs Act as the TICJA and the One Big Beautiful Bill Act as BBB. All right, just to keep things simple. So, the prior legislation before the TICJA was the Tax Reform Act of 1986. So, when the TICJA came into play when Trump was elected back in 2017, 2018, what it really did was reduce some of the marginal tax rates for individuals, greatly increased the standard deduction that folks could take. It increased some of the child tax credits and also greatly increased the federal estate tax exemption. So I know the BBB was passed here on July 4th. It does hold true to its name with being a big bill. It's nearly 870 pages. So I think the take home point here is the BBB really made permanent some of the provisions found in the TICJA and gives a little bit more clarity moving forward on some things. And be aware that some of these additional tax saving opportunities, deductions, and so forth may be subject to certain income phase out ranges. So to be able to qualify, you may need to have your income at certain levels. And we'll talk more about that here. So one of the major changes here, it went up a little bit, but the estate gift and generation skipping transfer tax exemption. So you may be wondering, what the heck is that? Well, the estate tax exemption, you almost want to think of it as a coupon that you hand in at death to pay for all the things that you've accumulated during your lifetime. So for most folks with the TICJA, that was around $14 million of a coupon you could have before you were assessed a tax, an estate tax on your net worth. So that was about $28 million married filing jointly couple. And the BBB increased that limit to about $15 million per person. So this is not going to affect a lot of folks that are out there. Those that are in the 20 to $30 million net worth range will require some planning around this. And otherwise, a lot of folks won't be affected. And what this does with the BBB is it gives you a little more certainty over the next 4 years, knowing that from an estate planning perspective for wealth transfers, this is going to be made permanent in law. And as always, when it comes to estate planning, you're going to have to do a balancing act to decide whether you want to gift property while you're alive versus gifting property and getting a step up in basis at the end. So this is a major provision that was enacted into this law. All right, now when it comes to individual tax rates here, the TICJA had the highest marginal tax rate at 37%. And also for corporations, they were stuck at 21% tax rates. Now, at the bottom left here, you have qualified business income. What is that? That is for those pass-through businesses. So if you're an S corp, if you're a partnership, if you're a sole proprietor, you may be able to deduct qualified business income if your income was within certain ranges. So this was a major tax savings component in the TICJA. And then moving over to the BBB here, we'll see that qualified business income is the same. That hasn't changed, except that the phase out ability, meaning the income you can have as a business owner, actually expands a little bit. So I believe for single taxpayers, if you're a business owner there, it went from 50,000 to now 75,000 as the starting limit for phase out. And then for married filing jointly, it went from 100,000 now to 150. So more entrepreneurs will be able to take advantage of this great tax savings benefit. And then also the tax brackets are staying the same. So historically speaking, these aren't the lowest tax rates we've ever seen, but they're pretty darn low historically speaking. So it makes these permanent and is a very good thing. All right. So another big change here with the triple B are changes to the standard deduction and itemized deduction rates. So with the TICJA, it was greatly increased. So for married filing jointly, it's about $30,000. And then for state and local taxes, if you remember with the TICJA, it really was capped at $10,000 for state and local taxes. So this was a real ding, if you will, for those that had really high property taxes over 10,000, and for those that really had high medical expenses or charitable deductions, they were really capped. Now, there's also this pass-through entity tax known as PTET. There's a little loophole. So for those pass-through entities that were S corps, sole proprietors, and so on, at the entity level, it could pay the SALT tax, and then essentially it would allow the entity to pay the tax on behalf of the individual business owner and get a business deduction for those SALT taxes. And then what would happen is the state would then credit a tax payment back to the entity. So the net effect was actually they were able to fully deduct all their SALT taxes. So that loophole still exists for those business owners. And then we also have the mortgage interest debt acquisition. So for those that are taking on a first home or vacation home, if you have 750,000 of indebtedness, you could deduct your mortgage interest. Before the TICJA was passed, the threshold was $1 million of indebtedness on a mortgage. And then for miscellaneous itemized deductions, those were things like paying or deducting tax preparation costs. If you were an employee and your employer did not reimburse you for certain expenses, it still remains that those are eliminated through the TICJA and also with the triple B here. Now, a major change or a big change is they've slightly increased the standard deduction. So it was 30,000 married filing jointly. Now it's about 31,500. However, if you're both age 65 or over for married filing jointly, you can now realize an additional $1,600 each in an additional standard deduction. And now, through the BBB, you could get up to an additional $6,000 each for being 65 or over. So think about it. You could have 31,500. You can have $3,200 if you're both 65 and over. And now you could do 6,000 per person for a maximum deduction of 46,700. However, there's a caveat here. You have to have modified adjusted gross income in certain ranges. So if you have 100 for married filing jointly, 150,000 or less, you both will receive the additional $6,000. They call it senior bonus deduction of 6,000 each. Once you hit 250,000 of modified adjusted gross income, you will not be eligible for both receiving the $6,000 deduction. So keep that in mind. Now, moving to itemized deductions, there is now a much higher SALT cap of now $40,000. It was 10,000 before, as we know, under TICJA. It's now 40,000. But you have to have income within certain ranges. So this applies as well. So for married filing jointly, once you hit 500,000, you can receive the $40,000 cap. However, once you hit 600,000 of modified adjusted gross income, you will not get the 40,000. In fact, you'll get the old $10,000 deduction. Now, this is really important to know. If we have situations where clients are making 500,000 or more, and they want to do, let's say, a Roth conversion of $100,000, well, if you go from 500 to $600,000 on that $100,000 Roth conversion, you're now paying almost like 30% more in tax. And the marginal tax rate on that Roth conversion of $100,000, what you thought you were paying a 35% marginal tax rate could now be as high as 45% at the federal level. And that's not including state tax. So this is something to be really aware of for those high earners that we work with. And then as you can see here, the pass-through entity tax, that remains along with the mortgage interest and miscellaneous itemized deductions. So with that being said, I'm going to swing things over to Allison, and she can talk to you more about some of these other key provisions.
So we have back one. We
Oh,
have
go back.
some bumped up expiration dates for clean credits. The new and used clean vehicle credit, which was worth up to $7,500, and the energy efficient home improvement credit, which was worth up to $3,200. They were scheduled with TICJA to expire in 2032. They're now expiring in September and December 2025, respectively. So there is still time to take advantage of those TICJA era credits, but it is going fast. So if you're looking to buy an EV or make some energy related improvements on your home, now's the time to do it. We also have some new deductions coming through. So there has been a lot of talk about no tax on tips or overtime. For tips, those working in qualifying professions can take a deduction up to $25,000 on their federal return. As for overtime, the deduction is $12,500 if you're filing single and $25,000 if you're filing jointly. To be clear with this one, just so nobody's blindsided when they go to file their return and say, that's not what I thought it was. The overtime deduction is specifically applied to premium pay. So let's say you're making $15 an hour and you make time and a half for overtime, so $22.50 for overtime. The $7.50 per hour that you're getting paid extra, that's the deductible portion. Both of these are going to be available tax years 2025 to 2028. And as long as your adjusted gross income is below 150 if you're single or 300,000 if you're married filing joint. After those thresholds, there are phase outs. And of course, filers are still going to be responsible for any state, local FICA taxes, which is, Medicare, Social Security. The OBBB also introduces a deduction for auto loan interest up to $10,000 annually, which is awesome. You should qualify for at least a percentage of the deduction if you took out, there are very specific rules, a standard secured auto loan for personal use after 12/31/24 for a new vehicle assembled in the US, and you have a modified adjusted gross income of less than 150 single or $250,000 married filing joint. This one also expires after the 2028 tax year. And finally, if you're making cash donations to charitable organizations, you can deduct up to $1,000 filing single or $2,000 filing jointly without having to itemize. So you still get your standard deduction, and then you can also get a tax benefit for that charitable donation. And it's not why you do it, but it's a nice perk. So take advantage of it if you're making those contributions anyway. This deduction begins in the 2026 tax year. Finally, we're going to cover, I'm just going to go through the list here of some of the other notable provisions with the OBBB. There was a creation of Trump accounts, which are tax deferred savings accounts with a $1,000 federal subsidy for children born between 2024 and 2028. Personal exemptions are now permanently suspended. So we don't have the standard deduction. We only have the standard deduction or itemized expenses at this point. Higher income individuals who are subject to the alternative minimum tax or AMT. With TICJA, they saw increased exemption and higher phase out thresholds, but they were temporary. So this is one of the ones that Greg was mentioning earlier, that this is now a permanent update. 529 plans, which are tax deferred education savings accounts originally used for traditional college, they were expanded back in 2017 to also allow a $10,000 per year withdrawal for K through 12 expenses. That limit was bumped up with the OBBB to $20,000. Additionally, the OBBB is now making it further expanded to include expenses related to homeschooling and also post-secondary credentials such as, like a CPA or a CFP, materials and exam fees. Individuals and families with children are going to see an increase to their child tax credit. Again, back with TICJA, it was increased from $1,000 to $2,000. With the OBBB, we're getting another slight bump. It's now $2,200. And lastly, the threshold to issue a 1099 miscellaneous or NEC, which is used to report non-employee compensation, NEC, was increased from $600 to $2,000. Of course, there's, Greg mentioned it's a big bill. There's plenty more in this recent bill, but this covers, I think, a lot of the legislation that is going to affect the people that we think are watching this, and then the demographics that we're frequently working with.
Thank you, Allison. And once again, there's a lot here. So everyone's situation is different. And I think this drives home the point that tax planning is really an important component of maximizing this bill and its different provisions. So once again, we hope you found it valuable today. And until next time, we'll see you soon. Take care.